When investing is especially a new topic for someone, so often fear dominates the conversation. Whether it's the next bubble's just around the corner or the next major market crash is just about to happen, so why in the world would I put money in today? Today, we're going to redefine what market risk is to put it in context of what it is, what it isn't, and help you be a little more comfortable with it. But Lyndon, you've been investing for quite a while, right?
Mm-hmm. Yep.
Help me understand what market risk is.
Market risk is the probability that the money that you invest is going to drop in value, and you're going to need that money during that time when it's dropped in value. In other words, you go out, you buy some stock, and a year later you go, well, I need that money, and you want to sell that stock, and during that time that you need the money, that stock is actually dropped in value.
So you're saying I could lose money?
Yep.
Oh, okay.
You could lose money. Yep.
All right. Isn't that what everybody's afraid of? So if I want to buy a car in a couple years, and I've saved up for that, should I go invest it if I want to buy a car in a couple of years?
If you're wanting to buy a car in a couple of years, saving for a down payment on a house, your emergency fund, you shouldn't invest that in stocks. It's that simple, really.
Oh, okay. So I actually could lose that money,
yeah,
and actually could mess up that goal. So that's a valid fear.
Right. Mm-hmm.
Right? Okay. All right. Well, that makes a lot of sense why somebody would be hesitant to invest money when they might actually lose it and miss their goal and objective.
Mm-hmm.
Okay. So how do I reconcile that? How do we go about investing in investments that do go up and will come down at some point, and reasonably expect to be able to do it in a way that we're not going to lose money, and we're probably going to make money, potentially a lot of money. How do we go about doing that? Can you speak to that a little more?
In order not to be sure that you're not going to lose money, you just need time on your side. In other words, you need a time horizon that is long enough that you know that those investments are going to go up in value during that time. And of course, we can't predict the future, and the past really isn't a predictor of the future, but over the last 50 years, if you've had somewhere between 3 and 5 years where you don't need that money, you would have never lost money with your investments.
And is that with a particular index or a penny stock, or?
I'm not talking about individual stocks, certainly not what some people call penny stocks, which are very risky, but I'm talking just investing in the overall market. And there's ways that we
the
can
S&P
do that.
500.
Like the S&P 500.
Okay. All right. So if we know that we can invest for at least 3 to 5 years reasonably, if not much longer,
right,
that's a fairly reasonably safe way to go about investing.
That's correct.
All right. Let's bring it back around to the opposite side of the conversation.
Okay.
Now, some people, from what I've seen, like to not invest in the stock market. They like to put it in savings or maybe buy CDs, stuff it in their couch, whatever. What's the risk with keeping your money very conservative over time?
Yep, I've seen this also, where people have invested conservatively because they're afraid of losing money. But they're actually subjecting themselves to probably a greater risk, and that is that they won't have enough money. They won't have enough money saved for any of their long-term goals like college, but especially for retirement.
Mm-hmm. Right. The power of compounding interest.
That's right. Goes way down. There's a big difference between having a 5 or 6% rate of return on the average and an 8 or 9% rate of return.
Right. Because if you're talking about $1 million of investment, 5% compared to 8%, that's a $30,000 per year difference.
Right.
That's huge.
Mm-hmm.
All right. Well, Lynn, thanks for sharing more on market risk and how time changes the amount of risk in the situation, whether we're talking about an aggressive investment or a conservative investment.